All right.
Thank you.
All right. Well, we good on the mics? Yeah. Thank you everyone again for coming. This is going to be a fun conversation because Sandeep and I have we actually went to the same college, but we never knew each other in college. We have a mutual friend, who's a dear friend of both of ours, and so we met through him, and we've never talked about any of this outside of this conversation, really. So this is going to be fun. Most of the times when we meet, we talk about our kids and all sorts of other stuff.
Or cricket.
Or cricket, yes. The World Cup is going on for those of you who are not aware. Anyway, so Sandeep, you've had a storied career in Fintech, right? Starting from Capital One and then Lending Club and Affirm, and now you're advising various startups. So talk to us a little bit about, focusing on risk and credit. Talk to us about the evolution, like in the last 20 years or so. What have been the big trends that you've seen, kind of
Sure.
in this industry?
Yeah, no, and thank you for having me. This is exciting, and it's actually great to see this turnout. And feels like we as a city need more events like this. So I'm really glad we're doing this. So there's actually a lot that has happened in these 20 years or so. Maybe I'll talk about three main trends that have actually that I think have been really critical, and maybe a couple of other seminal events that have happened over this time period. I mean, the first one's all about technology, right? And that whether that is about the way data is being used, whether that's about evolution of techniques. Obviously, when we talk now about XGBoost and all kinds of other machine learning algorithms and custom variables, that certainly wasn't the case when I started in this industry in 2000. There's a lot of judgmental decisioning still happening. But technology just goes beyond data and modeling. All of the stuff that is happening with the smartphone and the digital marketing and all of that, and we can unveil that further as we go along. And the second big thing is regulation, and I don't think that gets talked about as much. I actually think if you look at how consumer debt has really galloped over this time period, I mean, a bunch of that is actually related to changes in regulation, whether that is the change that happened with student lending in mid-2000s when the government started to get more involved. You can see how student loans how that loan balance has gone up so much. Or the Card Act that happened in 2008 when that kind of also opened up the possibility of other kind of lenders outside the banking industry coming up. And then the third big piece is, of course, been how the interest rate regime has been. This whole zero interest rate policy has led to the supply of credit that's just unparalleled, right? And I don't quite think we're going to see that again anytime soon, or perhaps not in my lifetime. But that's something that we can talk about as well in terms of the implications it has had on credit risk management. But I think I'd be remiss if I didn't mention two specific events that have also led to lots of changes. One, obviously, is the great financial crisis. And I think people started to realize at that time, the multiplicative effect of risk increase is higher in prime versus subprime, or that variables change their signs in models because a big mortgage is not always a good thing, right? That kind of stuff was actually really important for people to start to think about credit risk management more holistically. And then the last piece, of course, is more near-term, the effect of the pandemic and all of the transfer payments that happened from the government, what it has meant in terms of perhaps for some time period, the risks and delinquency picture looking particularly subdued, perhaps unnaturally so. And also its impact on some more generic credit risk scores like FICO that have actually been really inflated. And so what does a lender do with that? I mean, I think those events combined with some of the trends that I was mentioning have actually meant that the last 20 years have seen a lot of change.
Yeah, it's fascinating. As you were saying that, I was kind of thinking to myself, most of the stuff that you mentioned has has not a lot to do with technology. Like one thing, the first point you made was data and technology, yeah, sure, but everything else is
Yes.
regulation, interest rates, all the actions that the government took,
Yep.
right? So that's it's good to kind of just go up to the balcony and think about that for a little bit. Now, of course, that has led to a lot of innovation happening as well, but it's interesting to kind of think about what's the cart, what's the horse.
Correct.
Right?
Correct. Exactly. And where we a lot of times we talk about how demand for credit has changed, but I mean the supply of credit has actually been really affected by some of those pieces. And just as a specific example, if you go back to the time period just after the Great Recession, let's say 2010 or so, when the capital requirements went up, the banks were really hunkered down. There was all the stress testing and CCAR stuff happening. There was not a lot of lending happening through traditional channels. And that's when you saw, I worked at Lending Club for a little while. The first version of all these fintech companies coming along at that time. And that actually meant newer products came along. There were different ways of engaging with the consumer. The consumers started to use these products differently. Sometimes, not all good, because then stacking of credit products started to happen that led eventually to increases in credit risk and all of that. But yeah, I mean, all of those pieces have had a bigger impact.
Yeah, you mentioned the pandemic, and you mentioned government influx of loans, etc., and all of that. Has that led to any innovations, like on the technology side, in your opinion?
Well, I think one of the things that happened soon after the pandemic with the small business side, for instance, with PPP loans and such, was there were some fintech lenders and neobanks that actually took advantage of that opportunity and actually came up with different products or different ways of getting out to the consumers and harnessing that opportunity. That's the first thing that comes to mind, because I think the first impact was actually felt more on the small business side than on the consumer side. I mean, there were other innovations that happened very quickly where lenders actually really just rapidly changed their policies around collections and servicing and providing payment holidays to people or loan modifications. That was stuff that technology resources always limited, especially in smaller companies. That's not where innovation was earlier, right? I mean, and then suddenly people pivoted to make sure that the consumers were being taken care of in that regard.
Yeah, you mentioned that going back to 2000 and Capital One, right? A lot of the stuff used to be based on judgment,
Yep.
right? And humans looking at applications and exercising their judgment and whatnot. And fast forward to now, where a lot of this is just happening with machines and whatnot. The speed at which we make these decisions, right, and the accuracy that with how we measure accuracy and whatnot, all that's evolved in the last. So, in your mind, how do you think about the trade-offs? Like, do you think when it comes to those things, do you think we're better off now than we were before, or?
Yeah, I mean, I certainly think that we are better off now than before. I was just going back to some of those Capital One days, and I think actually I owe a lot to Capital One just in terms of what I have learned from them and the approach that the company took back in those days about just being very objective, very data-driven, just not having subjectivity or judgment come into play when the broader industry hadn't evolved. So one of the things I remember, actually, I was a credit analyst in our small business credit card division, was we tried, what would happen if you actually used a judgmental process. And so we had a stack of, credit files, and actually paper files at that time, I suppose, that we gave to some analysts and asked them to make some decisions. And they made certain decisions about, approve, decline, what credit line to give them. And we reordered those and gave them the same set a few days later. And of course, the decisions are very different, right? So
your own version of K-fold evaluation then.
Yes. So I think the impact that technology has had is real. The objectivity that has come in is absolutely. I mean, there's a big difference around that. Now, I mean, that's not to say that sometimes the models would do a bad job and will have a blind spot, and certain kinds of judgmental overlays can actually help you to train your models better, and frankly, maybe even this all hyped AI can actually help in that regard in terms of augmenting what the models do. But I do think that the trade-off has been, generally speaking, for the better, and even in cases where, let's say, a model is making very tight decisions about containing fraud losses. We all look at not just fraud losses, but also what the false positive rate has been, and just in combination with those can focus more on things like conversion.
Okay, that was another thread I wanted to pull on, which is think about fraud. Has fraud decreased between the time things used to be manual or judgment based and now, or has there been an increase in fraud?
Certainly, more recently there has been an
Yeah.
increase, and that's obviously also driven by the fact that all of the technologies that hold so much promise in terms of getting things better, when in the wrong hands, can also lead to very, very sophisticated fraud traps, right?
Yeah.
So there has been an increase. Now, obviously, the tools that are available for companies to fight that have also become more sophisticated, and there's always this constant balance of trying to figure out how tight do you get and how do you manage your false positive rate.
So, actually, just again, building on that, and to your point about the way the world works now, we use more data, and the objectivity, the decision process is more objective. How, like, starting from the days in Capital One when there were files and there was a limited amount of data being used, how has the usage of data evolved over the years? Like, starting from first you used to look at 3 sources, now we look at 300, and the types of sources have increased. So talk to us a little bit about that.
Yeah, sure. So I think maybe a few different ways in which we can talk about that. One is just, all said and done, the bureau data on the consumer side is still the most powerful source of data that's out there. But the way that's used is very different, right? Very few people now actually look at summary variables that are coming from the bureau. People would actually just get the XML file and figure out how to parse that data that is more contextualized to their situation. How do you create custom variables that really are important for what you're doing? How do you use some of the more machine learning oriented techniques to actually come up with those data variables, right? Then there used to be, there would be some simple techniques like a logistic regression or whatever. From there, how do you get to a place where, based upon how you use the data, or based upon your confidence on the strength of experimentation that you've done or testing that you've done, how do you create a variable that might have 100+ models, but you're confident that it's not overfitting, right? That you're confident that it's actually going to translate more generally into in the future, right? That started to happen much more so, and it was a bit of an evolution over the course of 2010s that happened. I think the second thing then is, alternative data sources. And there have been a lot of those. My personal view is that I think there's still ways to go on that. It's been a little bit harder for the industry in general to be able to, especially in the area of credit risk decisioning. Fraud's a little different. I think that's been.
So tell us a little bit more. What are these? What do you mean by alternate data sources?
So things like, there are data providers that might tell you whether somebody has been evicted in the past, or whether they have a judgment or a lien on their property, right? Things like that may not be available to you. There are payroll data sources that tell you about employment history and such, right? And those kinds of data sources are important. They provide additional information. It's just that sometimes coverage is not that strong, or that you're not able to backfill that easily to be able to backtest and employ them in a way that can be really cost effective, right? Because just creating those data pipes, trying to get that data, trying to do the retro-analysis is harder.
Yeah. No, and actually, so it's interesting, the couple of examples you gave, right? It's a nice segue into the question I want to ask you about. We hear a lot about fairness, bias in these models, and of course, like, models only as good as the data it was used to train the model. Now with these alternate data sources, you're looking at things like delinquent history and income and all of that, right? I would think that exacerbates the bias/fairness problem. So how do you think about reconciling the two, and bias and fairness in general?
Yeah, no, I think it is a challenge, and I think and something that certainly should not be taken lightly. I would actually say that I I give a lot to the props to the regulators when it comes to fair lending assessment and the way that is done. I mean, especially, there are critiques of the algorithm that the CFPB uses, for example. But still, I think by and large, when regulators come in and sort of look at what disparate impact might any of these models have, or the actual competencies that lenders have developed in terms of seeing the impact of their policies, I think it's real. They actually do make an assessment of that. I also think that things have evolved in such a way where the baby is not being thrown with the bathtub, as in if there is a particular variable that actually doesn't have a good substitute, but has a lot of risk splitting power, but might have a certain kind of bias. You document that, you understand why you're using it in business logic. All of that has actually now become more institutionalized in a way that that actually tries to get over some of that bias. I mean, that coupled with model validation, where there are some very clear guidelines from the regulators around what's to be done and what needs to be adhered to, I think has tried to get over your bias, because you're right, some of these variables can actually they can actually be somewhat problematic.
And there are indirect implications also, right? Like you may not have race or ethnicity as an explicit variable in your model, but if you use zip code, that is an indirect indicator of race or ethnicity as well, right? So are regulators hip to all that?
Absolutely. Yeah. No, I think the industry is actually quite tuned into this consideration, right? Around not making sure that there are no proxy variables, right? Making sure that they are doing that kind of an impact assessment, right? In terms of not just the disparate treatment, but also the disparate impact as the nomenclature goes, just the impact of their policies. There's actually really good assessment of that. I actually feel quite good about how that thing is working right now in the industry.
Because I do a lot of work in privacy compliance, and the regulators are not as evolved. Let's just say that we, as software companies who build privacy compliance software, we would love for there to be a more systematized regulatory regime, if you will, or body that enforces these regulations. It sounds like in lending, at least, they've got their act together.
Yeah, that's my belief.
Yeah, but so what kind of requirements do they impose on you? So you hear these days a lot about responsible AI and explainable AI, and the example that people most commonly give is, oh, this bank was doing lending, and look, this African Americans weren't given loans, and white people were given loans and whatnot, right? So what techniques or standards or frameworks, tools, what do you want to call it, do the regulators bring to bear in evaluating the work that you and your teams may have, or teams like yours may be doing?
So first, there is a very clear guideline on what are the regulations that one needs to adhere to, just on Equal Credit Opportunity Act. Just what is the kind of discrimination that's just not okay. There's guidelines on how particular kind of data that's being used needs to be this FCRA compliant, the Fair Credit Reporting Act compliant. And what does that mean in terms of what can be used? Very clearly, there is almost established case law around what kind of data sets can be proxy variables that need to be avoided. All of that. When somebody is declined for credit, there is specific guidelines around how do you come up with what is called adverse action reasons, right? Which is what is the specific reason because of which you were declined. And the regulators are actually really pushing on specificity around that. I mean, you all might have seen this new CFPB publication or circular that came out more recently that was talking about, well, as we tried to infuse more data, in that particular case, they were talking about purchasing history, and some of the more AI-enabled tools now allow you to use some of the data, such as purchase history that might have been really messy to incorporate before. But if you incorporate that, you can't just say you were declined because of your purchasing history, right? I mean, it has to be more specifically, well, in that example that they were citing, it was more using cash advance at a particular kind of business establishment or whatever. So I think the way you have those adverse actions being conveyed to the borrowers is also another way in which.
Oh, interesting. So like you mentioned, there are these regulations or guidelines for the data itself. So even before you build your models,
Yep.
you have to demonstrate that the data that you have meets certain requirements.
Correct.
So where do you put that in? You put that into your data pipelines that kind of build the data sets you need for models?
Yes.
You have to maintain reports. How does that
Yeah,
work?
no, you have to build that in early on in terms of in your data pipelines and the data that your data science team is using to evaluate those. You in fact have to show some of the univariate correlations. You have to actually work with the compliance team to make sure if you're ingesting some new data that's okay. Certain times there is some tests around monotonicity of the data that you have to make sure of. So in most of the banks, best fintechs, this science is actually really well done. Yeah.
Oh wow, cool. That gives me a lot of confidence, right? And
Yeah.
it reassures me a little bit that when Wells Fargo rejects my loan application, they do it for some reason or the other.
Well, yeah. I mean, I think you might actually also hear that, oh, there's too much of that happening these days when it comes to regulation in general, right? When it comes to stress testing and SEEK, and it's like, well, First Republic failed and SVB failed, and we didn't catch it. Like, so what's the point of all of that? I actually think that there is always, room to hone this right, and maybe we have been too focused on some of the credit risk aspects and not enough on some of the interest risk management aspects. But I do think on the credit side, especially since the great financial recession, there's been a lot of focus.
No, because as I was thinking about this problem, right, like, and I come from the ad tech, martech world,
Yeah.
where you build a model that very simple, like predicts whether a user is likely to click on an ad or not, right? The feedback loop is near instantaneous,
yeah.
right? But for a model that is predicting whether a loan application should be approved or not, the feedback loop is months, maybe years, because you won't know if you approve a loan, you won't know whether you've made a bad decision or not until I default.
Correct.
Right, and if you reject a loan, you never know whether this was a good decision or not. So how do you think about that? That's fascinating, right?
Yeah. See, I think, and people do employ techniques such as reject inferencing to try and get over some of those blind spots that you're talking about. But I think, and I am actually a very big advocate of this piece. Experimentation and testing is really, really key. I mean, unless you have unbiased data, you are actually not going to build a good model, right? And that's actually not good business value. However, when you are testing something that is beyond the credit box that you currently approve, well, I mean, it feels like you're just wasting your equity to be able to go do something or capital. So having really well thought out testing programs is really critical. And when the rubber meets the road, it's actually difficult when you're actually having that conversation with the CFO and sort of saying, yeah, I'm actually going to use some of this capital to be able to test because I want to build unbiased models so that we don't get into this issue where because the feedback loops are so long, I make an error, right? I mean, it just feels like it's a little bit more. I mean, you have to build that argument. But I think good institutions have actually developed really strong cultures around having the right kind of experimentation and testing, and that really is key in my opinion.
I know it's a difficult. You need to have cross-stakeholder kind of buy-in and support across the organization to be able to implement frameworks and practices like that.
Yeah, and even with the regulators, right? I mean, you have to tell them that I will do a little bit of my lending with no expectation of any returns out of it. And I'll keep it limited, I'll monitor it, but I will do that. And it's like, well, why are you giving this person a $1,000 loan when they haven't had any loans in the past, right? And I think that just has to be built into the testing program.
Yeah. Wow, that's interesting. That's interesting. So you've been out of Affirm for a few years now. You've been thinking, exploring, talking to a whole bunch of people, advising startups and whatnot. What trends are you seeing? What are people doing? What are things you're excited about?
Oh boy, yeah. I think there are a few different things that I am excited about, and I'm seeing some really interesting development around. Right, one is in the small business space. Right, I mean, certainly when it comes to onboarding small businesses, doing know your business kind of procedures, I think there's a lot of innovation that is happening in that regard. I mean, some of the more AI-oriented techniques as opposed to the machine learning techniques are actually helping in that regard. Similarly for SMB lending, right, where you may actually, where the bureau information is not as strong, you actually need to use, you need to read the bank statements, or you need to read some documents to be able to discern valuable information. I think that's an exciting area. Being able to categorize transaction data when it comes down to, let's say, just customer management, when credit card lenders actually have reams of that kind of data, but merchants can be represented in different ways, and sometimes could be misspelled or could be messy, but just trying to figure out exactly how that data can be read properly so that engagement can be improved even further, right? I think that's another area. I think the one other area that I am personally quite excited about, and there's some work happening there, probably much more to come, is actually collections, which is, well, consumers has gone delinquent, and there are a lot of touch points that a lender might actually have with them, through phone, through email, through calls, some documentation of agent notes. And you want to know whether actually legitimately, should I give this person an extension of the loan? Should I restructure the loan? In what situations is that appropriate? In what situations is just not worth the while? Do I better reach them through channel X or channel Y? I think that's just ripe for the kind of innovation that AI actually enables.
Yeah, so just to feed that back to my example about you gave me a loan, 2 years down the road, I defaulted. Now you have a choice to make.
Yep.
Right? After you've sent me the 65 reminders, right? You now have a choice to make whether you want to change the parameters.
Correct.
Of the loan you gave me, or send
Correct.
People with baseball bats or whatever, right?
Yeah, thankfully that doesn't happen, but yeah, that's right. Right. I mean, or what might be appropriate, right? In some cases, it might be that take the example of auto lending, that the person actually really wants to be in their car, but they can't afford the monthly payment that's due on the 60-month loan. Well, should I extend it to 84 months, and would that actually make it better for them, right? Or I feel like no, I should have just gone and repossessed it yesterday, the car, right?
Yeah. All right. Well, Sandeep, thank you. I wanted to leave some time for people in the audience. You might have questions for Sandeep. Anybody have questions? Yeah, Ayush, go for it. Ayush always has a question.
But then I got more as I heard the talk. Thank you so much.
Sure.
Lots of great nuggets, and I want to take all the time, but I've never been declined for a credit card or a loan application, so the models might have something wrong. Gotta check that. So you're talking about the decisioning models and how they need to prove themselves, and connecting it to the earlier talk about banking as a service. Now, the old model of underwriting and approving application was collect a bunch of documents, upload it, somebody sees it, OCR, collect all that data. But now decisioning is becoming instant, right? With Play, banking as a service, you upload and within seconds you have approvals. Has that changed how credit risk modeling is done, or is it just the same process with faster data pipelines?
See, so I mean, I think there has been a constant evolution of credit risk modeling, right? And I think, especially when it comes to consumer lending, it's not that all banks or institutions have been able to keep up, right? I mean, I think, 30 years ago, there were probably thrice as many banks as there are right now, right? So, and even of the ones that remain right now, they haven't necessarily done consumer lending as it has become more and more consolidated, right? So it's become harder and more competitive because of some of those evolutions that we're talking about. But I think it's changed. It continues to change. There used to be a time when there were more, as I was mentioning, more summarized variables that were used in simple, regression models that people used to actually creating these custom variables, to creating these really large models that people are confident in assessing and monitoring and evolving. And yeah, latency matters. When you actually look at embedded finance, you want to make sure that the decisions are happening in nanoseconds, microseconds, that is really critical. Even when you are talking about things such as connecting your bank account through Plaid, you want to be very judicious about where you want to do it, because conversion matters, and just even that little bit of friction can actually make you lose the sale, and the merchant won't like it, and you won't like it. So just being very careful about just keeping an eye on conversion is actually really important, and tying that to your credit risk outcomes it just goes hand in hand.
Thank you.
What was your favorite part about working at Affirm?
Oh, gosh. Actually, it was a fantastic experience, right? I mean, there's lots and lots of parts that I really liked about working at Affirm. When I joined the company, it was about 270 people or so. Just the kind of camaraderie, the culture that was there, actually trying to always do the right thing by the customer, using cutting-edge technology, coming up with new products, the pace of innovation. I mean, all of that was just so energizing. I actually really loved it. And the coffee, that was great too.
I feel like nowadays
Just use the mic so we can have it on.
Thank you.
Yeah.
Yeah, I feel like nowadays conference cannot end without talking about generative AI. So how do you envision that being used in lending in the next, I don't know, 1 year, 3 years, 5 years?
Yeah, I mean, I think it's evolving. What I'd say is probably a little bit speculative, just my opinion, but I actually think there's a lot more that's probably likely to happen in the near term in the fraud space, just in terms of even imagining and simulating scenarios that you have to protect against, and trying to use some of the generative AI techniques to conjure up those scenarios that you want to be guarding against. I think as far as credit risk management is concerned, I do think some of the regulatory pieces that we talked about, adhering to them will continue to be really critical. I actually think there are many institutions that I know that don't even use XGBoost properly right now, right? So I think there's a lot more to be done there before generative AI really comes into being. But like we were talking about earlier, and there is more predictive data sources that can actually, because they can be categorized better, can come in as alternative data sources. I talked about the collections example. I think that's where it can be used more. I think it's on the servicing side, obviously, the things that are happening with bots and the way the AI tool is actually acting more like a banker in addition to just whatever else you were doing technology to make decisions. I think that is the other area that is certainly ripe for innovation. We talked about the small business side, just onboarding of small businesses, small business lending, because that was more document based. I think there's opportunity there. So those are some of the areas where I think you're likely to see more activity sooner rather than later.
I think as I'm thinking now in real time, you mentioned in your answer to Aisha's question, the speed with which these decisions get made, and actually. The mutual friend I was talking about, Puneet, he runs a company in India called Moneyview, and they literally have to make decisions in milliseconds about approving loans or not, right? The opportunity for Gen AI is in how can you keep the customer engaged through a chat-like interface where in the background there is all of this data collection, et cetera, going on, and as you are learning, you're engaging with the customer and getting perhaps more information from them that'll help you make the decision making, help you make the decision. So I think that while generative AI may not have a direct impact on the credit risk algorithm that you've implemented, but as far as the end-to-end user experience is concerned, I think you'll see a lot of innovation in how people use generative AI to radically transform consumer engagement as part of the lending process, I think.
Yeah, no, I can certainly see that. It's a very good point, right? Dynamically, how your application evolves as you're getting some piece of information could be a great example of that.
Oh, sorry.
Thank you for your presentation. Broader question about the industry as a whole, and especially about international. How will fracturing geopolitics, and especially BRICS, with the first legitimate threat to US dollar hegemony, affect fintech globally?
Boy.
How much time do you have? And there's not enough alcohol here.
Well, I mean, I feel one of the biggest things that is happening right now as a result of all of the turmoil that is happening is actually much more on how interest rates are evolving, whether that's directly because of impact of inflation or where the investments go or not go. I actually think the thing that first and foremost I'm watching out for is how does cost of capital change in the U.S. internationally, and that's probably going to have a direct impact. I mean, forget anything else that is more complicated or sophisticated than that. But the cost of capital evolving in the near term pretty immediately, I think that's something that I would be the most cognizant of.
Actually, and you mentioned BRICS, right? So one of the things that I'm insanely fascinated by, so both of us are from India, right? And the last time I visited India, so well, I started visiting India again in June last year. Before that, for 3 years, nobody was going anywhere, right? So when I went in June last year, the digital transformation that has occurred in terms of how people use money or lack thereof, like nobody uses cash anymore.
Yep.
Right? Your neighborhood vegetable seller, you can use universal payments interface. You can use your phone to pay that person, right? And now this is going to sound funny, but India has a huge problem with beggars and stuff like that. I've seen beggars who have phones, and you can actually pay them using UPI, right? It's fascinating, right? So that kind of transformation needs to occur. Like here, it's so complicated, right? And FedNow is one of the things that's coming out. That's a standard now for payments. So I think there's a lot of innovation that's going to happen in countries like India and Brazil and China, et cetera, that is going to drive innovation over here because consumers are going to get used to that and they'll demand it. So I think it's going to have a lot of positive impact as well in terms of pushing people and challenging people to innovate more over here.
That's a very fair point.
This might not be well thought out or right, but it feels like there's a lot of innovation on the data and the modeling for lending, but maybe less so on the business model. Affirm being a obvious counterexample to that. Why is that? Why don't I have people coming to me to say, hey, you've got this car loan at 2%, pay down a certain amount, and we're going to relend that. Like, I don't get offers for that. Why not?
Yeah, that's a great point, and actually very dear to my heart, because I completely agree with you. I think a lot of the innovation that happened in the last 10 years or so was very limited in the consumer side to a personal loan, a amortizing personal loan, which in its structure is quite simple, right? I mean, and you mentioned point of sale lending that Affirm did. It was very innovative, and there are a few examples to the contrary. But other than that, yeah, I mean, nothing much has happened in the broader space, and I'm hoping that will change. Now, why not is I don't know, a matter of opinion. But to me, it feels like in some cases, such as student loans or mortgages, the government's been involved. In my personal opinion, perhaps a little too much. On the refinance side, there was some stuff that happened on the student loan side. There are auto loan refinance products that were out there as well. I mean, clearly, this current interest rate regime is not for that. But over the course of the last 10 years, there were those products. Now, consumer habits change not that quickly, I suppose. And for one to convince somebody to refinance their auto loan for a saving that's obviously not as significant as it would be for their mortgage is a little tough. So there may have been a little bit of the consumer behavior didn't actually change as rapidly, but I agree with you that there hasn't been as much innovation in those other categories. Now, those other categories are also more complicated. You talked about auto loans, right? I mean, well, there's got to be not only the assessment of the creditworthiness of the individual, but also that of the collateral, right? I mean, what kind of a car am I lending to? How do you make sure that any kind of title transfer happens properly so that you actually have lien on what you're lending against? Those things are operationally pretty intensive. So in addition to you taking care of the capital to lend, there's the operational complexity that comes with it. There's all the stuff that remains around credit and fraud risk assessment. So it's orders of magnitude more complicated.
All right. Well, sure, go ahead.
So I work in the excuse me, I work in the finance transformation space, and so my question might be related to that. I mean, for any big organization, data is at the core of any operations you want to run, right? I work looking at like more traditional organizations, they're still a little behind in terms of where their data strategy is, how good and reliable their data is.
Sure.
On top of that, now they're talking Gen AI. They're talking about the CFO just asking, the interface, hey, what is my net income for this, whatever, right? How much of that is wishful thinking versus how much of that is realistic when there are still so many data issues in more mature organizations?
Yeah, I mean, I don't think that many folks would disagree with you on that, on the fact that you have to get the data backbone right? I mean, you have to have a consistent metadata. You cannot have the same variable being defined differently in two data tables. That happens all the time. We've all gone through that kind of nightmare, right? And so unless you actually get that foundation right, none of the fancy stuff is going to really add value on top of it. And I'm not saying anything here that is anything profound, right? I think at the same time, there's always that pressure to sort of say, oh, this new fancy thing is happening. What can we do about it, right? And sometimes that can be a little bit more wishful thinking. To me, it feels like, it's important to get that data infrastructure absolutely pristine and right, but at the same time, trying to find opportunities and quick wins for where you actually have something solid to try and continue to innovate is also important, because just postponing everything to tomorrow does lead to a space where a lot of companies haven't innovated, or a lot of banks haven't innovated, and therefore have just been shut out of the space, right? So in some ways, yeah, even if the majority of your effort has to go into getting that data right, trying to actually look for some of those slivers of innovations is I think important.
Yeah, we like to say, don't let perfect be the enemy of good enough.
Yeah.
Right. And well, Sandeep, thank you. This is a lot of fun.
Yeah, it was a lot of fun for me
I
too.
learned a few things too. So thanks a lot.
Thank you. Cool. Awesome.
All right.
All right.